You mentioned banks as well. Banks is another area where you have been in them for a long time, although off and on. And banks have been a sort of a tricky wicket, a sticky wicket this year, because a lot of people have liked the banks, and then we had that big sell-off in June, and then we haven't seen much from them at this point. What happens for the banks if we continue to see a flattening yield curve?
I think one of the things that happens with not just banks but with all kinds of sectors, industries, is people try and surf the market. They try and figure out when they're going to work and when they're not going to work, and using various kinds of heuristics. And we tend to take a 3 to 5 year look at these things. And so over the next several years, we think the great 35-year bond bull market ended in 2016, and we're in a bond bear market right now. I think the last 6 years, bonds have yielded a total return of 1.5%, the worst in history, and they've had negative returns the last 2 years. We think they'll have negative returns for years to come. And because the economy is going to get stronger, inflation is probably going to go up, which means the whole curve should shift upward. And because of the Dodd-Frank rules and the Fed's requirements, the giant banks are just awash in liquidity. And so as the Fed funds rate or short-term rates go up, that just pours billions of dollars into I think every 100 basis points increase in the Fed funds rate is about $5 billion pre-tax for JP Morgan. So we're looking at that and the fact that they're all well capitalized, they're raising the dividends significantly, they're buying back stock, and they're not expensive.
So the groups we're talking about, airlines, home builders, banks, they're not necessarily going to do as well if we enter the next recession. So if you're looking at this 3 to 5 year time horizon, are we closer to the end of that cycle of outperformance for some of these companies, or do you think we still have a few years to go?
Well, as I said, no one has privileged access to the future. So all we can do is look at the current situation and look at the forward-looking indicators and stuff that's tended to be early cycle indicators of recession. And none of that really is the case. People are worried about the yield curve at various points in time and about its flattening. But I think the flattening is probably mostly done. And if the flattening isn't done, then the Fed has already signaled that is a signal for them, because most recessions, obviously, almost all recessions are caused by Fed over-tightening.